estate investment firm has exposure to a lot, including some of the areas that the market's been a little bit concerned about, but you guys have a broad reach. Mark Gabbay, thanks so much for being here with us.
Thanks for having me, Oliver. But yes, we do. We're global, so we do have a pretty big reach, but it is sort of split, not exactly a third between the regions, but a little bit more weighted to the U.S., but we cover all the markets.
How do you feel right now? How confident do you feel about the real estate market?
We're feeling a little bit more confident. I mean, I think that the sector's been beat up and continues to get sort of beat up. And in the beginning of 24, we are starting to see some positive movements in some parts of our business. So we're cautiously optimistic. I mean, these are long cycles in real estate, as people know. So we've had a really good upcycle over the last 10, 11 years, and it'll take a few years to get through the bottom part of this cycle, and then we'll come back up again.
How much does history apply right now after what we went through with COVID, such a bizarre situation that really changed the way we think about work and this whole push towards work from home, and then it's kind of a push back? We've got this kind of back and forth.
Well, I definitely believe history repeats itself, so there are a lot of lessons you can take from history. Having said that, no two cycles in real estate are exactly the same, and that's sort of the same thing we're seeing right now. There's different drivers in this cycle compared to, let's say, the prior one, if you think back to the global financial crisis. This one's a lot more complicated, it's a lot more divergent. It's more geographic to some degree, so we're not getting the same activity level or the same changes in every single market or every single asset type. So there's a lot of complexity to what's going on. And in our view, when you have structural and cyclical changes like this and complexity, it tends to be a good time to invest. I mean, it's good, right? It's good from a historical perspective. You learn that those kind of inflection points are great entry points.
We saw today another hit in a regional bank, New York Community Bank, looked at their books, looked at some of the stuff they bought last spring and said, okay, we're actually more exposed and we've got more risk than they thought. Their kind of buying of the dip seemed to have backfired, and that's created concern around the sector that there are still potholes, if not time bombs, in commercial real estate. How severe do you think the risks are in some of these office spaces?
Right. More pothole than time bomb.
Okay.
I would say. There's definitely some issues in some of the bank books. There's definitely issues in the credit space when it comes to commercial real estate. It's probably more relevant in the office sector if you've got loans secured by office, but it's also in multifamily and other sectors. I mean, when the math changes so dramatically like it has with interest rates, and you had peak valuation in real estate, you're going to have issues on the debt side. I mean, that's a consistent sort of lesson that the market has learned, and it will take a few years to work our way through that. So there's some pain there, and I think there's more pain coming, but market consensus is that the market can absorb it at the end of the day. So we don't see what we saw in 07, 08, which was a complete lack of trust in the financial system, and then a run across all asset types, regardless of what they were, where they were, how they were valued.
It seems like some of this just kind of fits a natural separation of wheat from chaff, high quality businesses from maybe kind of one trick ponies in a zero rate environment where you look around America, there's all these different banks. Do we need all these different banks for every region? I'm curious your perspective from the real estate side. Could things function smoothly in real estate if the banking system kind of conglomerated a little bit more?
I think yes, and the main reason for that, and you've already seen the beginning of that trend in our space, there's quite a bit of capital raised for the credit space, for the real estate lending space. That's a trend that started a few years ago, kind of in anticipation of the banks kind of pulling back from the sector, less from a loss perspective, but more from a regulatory perspective or BIS capital requirements for risk positions. You're going to have contraction there anyhow. So our alternative sector has probably looked at that, and so there will be other capital types to fill that gap, whether it's institutional or high net worth private retail capital. Because fundamentally right now, the credit space in real estate with where rates are, if you're a fixed income kind of investor and you just want a dividend, that's a great place to be.
That the draw right now, still the general yield?
I think so. I mean, if you could get 4 to 5% in cash in the bank fundamentally, but in a real estate credit strategy that's secured, right, with some good equity behind it, you could be at 8, 9, 10% today. So that incremental return over your cash rate in the bank we would say is pretty attractive. And I think most people understand that 8-9% current cash paid is pretty good in this environment. Now, you don't have any upside. That's what you're going to make. But you also have limited downside.
Right. One thing we think about a lot, obviously, is traders, investors are trying to game when the Fed's going to do what they're going to do. How much does that matter in your world? Is there a debt wall somewhere anytime soon that's threatening if rates don't come down quickly?
There's definitely debt walls. I mean, you could see some of the data. It's in the trillions in terms of what needs to get refinanced over the next, say, 2 to 5 years in commercial real estate. It's probably anywhere from 500 to 750 billion a year of loans that are maturing. So rates play a big part in that, on how much of that can get refinanced. I mean, the interesting thing about our business is that, as people know, real estate's a long-term investment, and it's a very slow-moving investment, unless you're in the public space and you've got REITs and they're marking to market every single day. But on the private side, we move very slowly. And so there's actually an arbitrage between the rates market, right, which moves very, very quickly and adjusts, like what we saw 18, 24 months ago, to where our assets adjust. And so there's a natural lag between these two things, and that can create opportunities. So meaning, if we thought rates were going to come down dramatically in the next 24 months, where real estate pricing is today in the market, it's pretty attractive. But where rates are today and where real estate pricing is today, that's still got some room to go. So it is a future, bet on where you think rates will be. If you think they're going to come down eventually, then you should be in real estate right now. If you don't think they're going to come down, they may go up, then you don't want to short real estate.
Okay. When you talk about that lag effect, I was reading some of your literature about the appraisal lag. Is that a big factor in this?
In the private space, it is a big factor. And that's just the nature of how that business works, is that the appraisal system is looking for market data points, and it needs real transactions to feed back into it. Real transactions are moving slower, given all the items we've talked about.
The monthly, weekly data.
And so it's not, again, we are a slow, long-term asset, versus now people are used to instantaneous feedback in the markets, and we just don't work that way. So it's natural that the appraisal lag is there. But what it's telling us is it's starting to catch up with the spot market. So again, if you had a clean sheet of paper right now and not allocated to real estate, it's a great time to get into real estate.
Okay, just real fast, Mark, is there anything that stands out to you as being the safest, most promising locations, regions within real estate?
I think it's different across the world. I think if you believe you want to make a high return, then the U.S. is pretty good, because it probably is going to correct the most, and it's going to recover the fastest. Europe is probably somewhere in between. There's also going to be some corrections there. Asia has been a bright spot and is a lot more stable in general, China excluded, right? So it really depends what risk return you want. We primarily really still like multifamily and industrial, only because the fundamentals underpin those sectors, and the cash flows should be consistent going forward, and they should have some growth. But if you said, where would you put your money today, like right now, I'm in the real estate credit space.
Okay.
8, 9, 10% all day long for me feels pretty good. But everyone's
not
different.
bad when you get 4.5% in bonds. Mark, thank you very much for your time.
Thanks, Oliver.
Glad to have you here. Good conversation to end the week here. Mark Gabbay, Global CEO at LaSalle Investment Management.